Hope you're doing well. This video, I'm going to walk you through a trade I took today, as well as take a quick look at how the weekly candle for this week played out on the basis of our pre-market analysis. So if you've not watched that pre-market analysis video, I highly recommend you check it out. You can find it on my channel. That's it right there. Emini S&P 500 pre-market analysis for 29th of January 2023. And this was a video that I released a week ago, almost a week ago on Sunday. And in that video, what I discussed was for this particular week, these two relative equal highs were my interest points. I felt that they looked like resistance. It would look like resistance to most retail traders, and the algorithm would likely seek to take that out. So when we started trading at the start of the week, this is how the chart was looking, right? So my thinking, my assumption, my expectation was that we would likely seek to take out these relative equal highs, and as you can see, that's exactly what happened in the course of the week. All right. So once again, if you've not watched this video, please go and watch that video. I talk about how you know equal highs were my interest points, my drawn liquidity for the week. And at the start of the week, what we had was price opens here, pushes down, hits the weekly bullish order block, and rallies all the way and takes out these relative equal highs. Okay. What you need to understand is price moves on the basis of order flow on the daily and weekly time frames. And that's why whenever I'm starting my weekly analysis for the week, I always start from the weekly chart and then I break it down on the daily charts, sometimes the 4 hour. And yeah, pretty much that's it for my weekly analysis. I try not to go below the 4 hour because it's really for me to understand the key levels I should be anchoring my trades on during the course of the week. So there's usually no reason for me to go lower than the 4 hour time frame. Another thing I do want to mention here is price moves on the basis of one of two things. It moves on the basis of either an inefficiency or liquidity. That's the only thing price is doing. It's moving on the basis of liquidity, whether buy side or sell side liquidity, or an inefficiency. It moves on the basis of liquidity and inefficiencies. Liquidity here being buy side liquidity or sell side liquidity. An inefficiency could be a fair value gap, a volume imbalance, or a weekly opening gap. All right, that's all price is doing. It's either moving between a liquidity pool to a liquidity pool, or it's moving from an inefficiency, a fair value gap, uh, a volume imbalance, or a weekly opening gap is what draws price. That is what causes price to book. And so whenever I start doing my analysis for the week, I always ask myself, what is the most obvious draw on liquidity? Who is likely in the crosshairs? And for this particular week, like I already mentioned, I saw this high and that high, and I felt these highs would look like resistance to retail. And therefore, I would expect the algorithm to want to take that out and maybe push higher into this volume imbalance, right? But we'll talk about that in another video. All right. So that was my reasoning. That was my rationale for this week, and Price delivered it beautifully. So now I want to jump to the daily time frame. So I'm just going to go to the daily time frame. And on the daily chart, we see that price on Monday, we have this bearish move to the downside. Price opens, trades down, hits the weekly order block, and begins to rally all the way till we take out the relative equal highs we noted on the weekly time frame. Now, once we take that out, we did that on Thursday, which was yesterday, we can see the price left behind an inefficiency, a volume imbalance. A volume imbalance refers to the space between this candle's high, this candle's close and this candle's open. In between the close of this candle and that candle, there's a volume imbalance. Okay, if you look here, this candle closes and this candle opens where this candle closes. This bearish candle closes here, this bearish candle opens here. Then we have this bullish candle. It closes here, and where it closes is where this next candle, this next bullish candle opens. But in here, this candle closes here, but this candle doesn't open where this candle closes. It opens higher. So the area between where this candle opens, sorry, where this candle closes and where this candle opens, that area is your volume imbalance. It's an area where you don't have any candle bodies. And so when we started trading for today, my reasoning, my thinking, my expectation was that price would likely want to draw into this volume imbalance on the daily. Remember, I said that price is moving based on one of two things. It's either going to liquidity or it's going to an inefficiency. Liquidity could be buy side or sell side, and liquidity comes in the form of relative equal highs, relative equal lows, and also in the form of old highs and old lows. It comes in the form of previous days highs, previous days lows, previous weeks highs, and previous weeks lows, session highs and session lows. That's what drives the market. So in this instance, I saw this as an inefficiency, and therefore it could act as a magnet to draw price towards it. All right, so that was my thinking. My thinking was we could draw into this volume imbalance. So jumping down into 15-minute time frame. And admittedly, this trading day isn't a day you should generally be trading because it's NFP. But yeah, this was a demo trade, so I was relatively safe. So on the 15 minutes time frame, what do we see? We see that before the 8:30 NFP release, right? Before this candle, this big beefy candle, price rallies up and takes out these relative equal highs. Remember, the market is being drawn to liquidity and inefficiencies. So before the news release at 8:30, before this candle starts, so from here to here, this is your kill zone. This is your New York AM kill zone. So before this candle is formed, we see that price rallies and takes out these relative equal highs. Why? Because retail is going to be seeing this as resistance. So we stab it just a little bit, and then at 8:30 we tank heavily to the downside, and we tank into the daily volume imbalance. Okay, and we completely redeliver to the daily volume imbalance almost to the tick. There's just a little space. It's practically filled it entirely. Right? So we take out these relative equal highs and then we tank taking out these relative equal lows. When this happens, then that sets the stage for my trade idea because my expectation was price would push lower into the volume imbalance. Now, I didn't want to trade NFP. So I waited for NFP to do its damage and then I went long. The reasoning for going long is once we re-deliver to this volume imbalance, price should move away. Why? Because this is a higher time frame institutional level. Okay, so price should want to move away. Now, additionally, we were in a deep discount. Why were we in a deep discount? The opening price for this candle here, where we have this line, this purple line drawn, the opening of that candle extend out in time, and that becomes your midnight opening price. I didn't put it on the chart because it's going to make it clumsy, but the opening of this candle right here, that is your midnight opening price. Okay, price trades lower, trades below the midnight opening price. The opening of this bearish candle that forms at the NFP release, that is your 8:30 opening price. Price pushes lower below the 8:30 opening price. So we're below the midnight opening price. We're below the 8:30 opening price. So that means we are in a discount. We're in a discount for the day's range. So in that discount, you don't want to be shorting. You want to be looking for longs. Why? Going back to basic algorithmic theory, you want to be selling in a premium and you want to be buying in a discount. So we're in a discount. We've taken buy side. We've taken sell side. We've tapped into a daily key level, volume imbalance. We're below the 8:30 opening price. We're below the midnight opening price. The likelihood for a reversal is very, very high. All right. So once this narrative was painted on the 15 minutes, I jumped all the way down to the 1 minute chart. Now, on the 1 minute, we have let me just get rid of this now. We have the 8:30 NFP release in red. Okay, let me just bring this. Just bring this. We have the 8:30 NFP release. Okay, price trades into the daily volume imbalance, this yellow shaded area, to the exact tick, the lower end of the daily volume imbalance, and then price rallies aggressively. Now, when I saw this form, I saw this breaker forming. Okay, so we had a low, we had a high, we had a lower low, and then we broke past this candle right here, which sets the stage for a bullish breaker. Okay, so I knew that it would be difficult to get an entry. I just anticipated that we may not get a return into a discount once we break structure here. Why? I didn't really see any fair value gaps on the 1 minute time frame. So I anticipated that it's unlikely that price may want to come back down once we trade past this breaker into this area. So what I did was I marked the breaker and then I went lower to the 30-second time frame. Okay. Now in the 30-second time frame, what you see, I'm going to go back to the 1 minute charts in a second, but what you see on the 30-second time frame is once we break past the breaker, we do leave a little fair value gap within the 1 minute breaker. That was my entry. I went long right in there. I'm going to show you the executions in a second. I went long in there. Okay, so the breaker from the 1 minute was the narrative, was the rationale, but then I executed my long within the fair value gap within the breaker. So back into the 1 minute chart, I went long. Why? Because we were at a key level. And as price rallied, we created a fair value gap. Now, on the 1 minute, you cannot see this fair value gap. So again, obviously, I was looking at multiple time frames at the same time. So what I did was I checked the 2 minute chart. The 2 minute chart, what you will see is this fair value gap. So right here, what did we have? We had shift in market structure, shift in market structure above this high. Price takes out this high aggressively, and we have this fair value gap here, and price taps it very lightly. What's that? An institutional order flow entry drill, right? Price taps it very lightly, and then price begins to take off. Okay, so my first trade entry on the 1 minute, my first trade entry on the 1 minute was within the breaker. Now, as we rallied and came back into the fair value gap, I added extra positions. And what I then did, I continued to look at price for evidence that discount arrays were acting as support. Because if the market is going to continue pushing higher and higher, fair value gaps, which will be buy side imbalances, sell side inefficiencies, should support price. If the market is going to continue to rally, bullish order blocks should support price. So you see here, my first entry was within the breakout. We create a small fair value gap on the 2 minute. We tap it. I add extra positions. We rally. We form a bullish order block here. I looked for evidence that this would act as support. We had this reaction. Price pushed up, creating another fair value gap. And like once again, I look for evidence that this is going to act as support for price, and it does. Price rallies, and by the time it comes to this high, and up here, I take out my positions. Why? We went above buy side liquidity here on the 1 minute, relative equal highs. So I took some partials there, and then this imbalance was completely closed in. So this imbalance was completely closed in. And at that point, I no longer had an interest to keep holding the position. Now, admittedly, it continued to rally, but I had lost interest. And I was pretty happy with the entry. After all, I'm not even supposed to be trading on an NFP day. So for me, it was a very quick trade. Trade within the breaker, pyramid positions within the fair value gap here. Look for evidence that this bullish order block is going to be respected. We push higher. Look for evidence that this fair value gap is going to hold, and we push higher, and that's my trade. Now, to show you those executions, I'm going to right click on the chart, go to settings, go to executions, and you can see I toggle the executions on. You can see them appearing here. Toggle them off. They go. Toggle it on. Click OK. So those are my entries, right? So I'm going to show you the first one. The first one was here. 30-second chart. So first one was here. This fair value gap. Now back to the 1 minute. You can see that as the entry at the bottom here, the price rallies. It rallies, and then I'm looking at the 2 minute at this time, looking for any fair value gap forming on these lower time frames: 1 minute, 2 minute, 3 minute, 4 minute. So on the 2 minute, I see a fair value gap, and in that fair value gap, as price came back down here, I added my first position, sorry, my second position. Then when price came back after forming this fair value gap and tapped it, I entered my next position. And then how did I exit my positions? Exited my positions as we rallied above these relative equal highs. So as price pushed up towards this, took my first position off. Price rallied above that, second position off. Then as we rallied and came close to closing in, the fair value gap that was formed with the NFP moved to the downside, took off the rest of my positions. So very simple trade idea, but the logic is what matters, right? First of all, we had a daily volume imbalance. All right, that's this yellow shaded area. Price at NFP rallies and takes out sorry, before the NFP, it rallies and takes out buy side, and then it turns around and tanks, taking out sell side. Where are we? A premium or a discount? We're in a discount. Why? We're below the 8:30 opening price, and then we're also below the midnight opening price. We've tapped a daily volume imbalance, and then I look for evidence that price wants to turn. We get that evidence here, not fully here, but then it was very clear on the 30-second time frame. We form the breaker, then 30-second, we have a fair value gap. First position within that fair value gap. Second position on the 2-minute chart as this candle closes and this candle drops down. Second position there. Third position when price comes back and taps the fair value gap very lightly, and then price rallies, and then partials as we approach the buy side, partials as we break beyond the buy side, and then last position as we close in this fair value gap. And that was the trade idea. Now, the important thing is not the entry pattern. That's the easy part. The important thing, let me take off the executions now. The important thing is figuring out where price wants to go. Your draw on liquidity, right? And very simply, like I mentioned in the beginning, price is moving to one of two things. It's either moving to a liquidity pool, buy side or sell side, so relative equal highs, relative equal lows, old highs and old lows, or it is moving to an area of inefficiency, an area where price has not been efficiently delivered. An example is this. Price was not efficiently delivered here. So the algorithm is going to want to reprice to this area. And so I waited for the NFP execution. We got that repricing to the volume imbalance, and then we had a strong upward rejection. Now price has come back down to close here, but that's fine, right? You need to learn to be content, and I was more than content with being able to capture a move like that on an NFP day, on a day where we shouldn't expect price to be as clean as it was today. And yeah, that was that. So my advice, if you're a developing trader, focus on the higher time frames. Focus on the weekly chart. It will simplify a lot of things for you. And as you've seen, focusing on the weekly and daily time frames doesn't mean you can't take intraday trades. I literally did my analysis from the weekly chart down to the daily time frame, down to the 1 minute, down to the 30-second chart. So focusing on the higher time frames does not mean you can't take intraday trades. What it does mean is any intraday trades that you take, any scalps that you take, will be of very high probability. Why? Because they will be framed on a higher time frame narrative. They'll be framed around higher time frame key levels. And so you will not be caught up in the noise that is often associated with those lower time frames. So hope you found this video insightful. If you did, I'd really appreciate you leaving a like and considering subscribing to my channel. And until I talk to you next time, be safe.